Hi everyone, I'm Basil Nilamra, tutor for financial reporting. In this video, I'll be debriefing FR June 2024 mock exam, the section A part. Before you watch this video, make sure that you have already attempted the FR mock exam, which is available in practice platform. Now, the first question, which two of the following are not enhancing characteristics of financial information according to IASB conceptual framework? Verifiability, materiality, comparability, and relevance. It's a straightforward narrative question. Materiality and relevance are not enhancing characteristics of financial information. It is basically fundamental characteristics of financial information. And the examiner has very clearly given not enhancing characteristic. Verifiability and comparability are enhancing characteristics. So definitely materiality and relevance are not enhancing characteristics. Moving on to the second one. Read the requirement first. Match the following tokens to the appropriate target. So the tokens is given change in accounting policy, neither a change in accounting policy nor change in accounting estimate and change in accounting estimate. Now read the requirement. A Pilsen company is considering changes to accounting of certain items for the current year. The accountant is unaware about whether these changes would lead to change in accounting policy or accounting estimate. Match the following tokens to the appropriate target. A change in estimated useful life of an equipment from 8 years to 5 years. This topic is of IAS 8, changes in accounting policy, accounting estimate, and prior period error. We have learned that change in estimated useful life of an equipment is basically change in accounting estimate. So the first one is change in accounting estimate. You'll have to drag and drop this to this target. I'm facing a small technical issue with respect to the practice platform. So the first one is change in accounting estimate. Second one, a change in classification of an item of expense from general and admin expense to cost of sales. So this is definitely a change in accounting policy. So you'll have to drag this from here and drop it over here. And the last one, change in nominal value of equity share from $5 to $1 per share. It is neither a change in accounting policy or a change in accounting estimate. So the first one is change in accounting estimate. The second one is change in accounting policy. And the third one is neither a change in accounting policy or a change in accounting estimate. In your exam, you'll be really able to drag and drop this here. I'm sorry, I'm facing some technical issue with my practice platform. Moving on to the third one, it's a number question. And they're asking you to fill in the blanks by inputting dollar value. Now you have to be very careful when you input the dollar value. Some questions will ask you to input dollar in thousands. So in that question, you'll have to input in thousands. Some question will ask you to input in dollar million. Some questions will ask you to round off to 2 digits or 1 digit, etc. Here, you don't have to worry of any of those things. Here, the question is asking you to show it in complete dollars. Now, first read the requirement. What will be the finance cost charged in profit and loss account for the year ended 30 September 2000X5 according to IFRS 9 financial instruments? Now, you should be very carefully, you have to consider the year end 30 September X5. The question is related to IFRS 9 financial instrument. So now read the question. On October X4, Fairdeal issued loan note with a nominal value of $1,000 with a total value of 2.5 million. So issued loan note. So definitely it's a financial liability. And in case of financial liability, the finance cost will be shown in profit and loss account. And it is effective interest that will be shown in SOPL as a finance cost. The issue costs were 3% of the nominal value and were paid upfront. The loan note carried 6% per annum payable at the end of each year. Loan notes are repayable at a premium, so the effective rate of interest would be 10.84%. Now, always remember in your financial reporting, whatever be the accounting standard, the effective interest will be shown as income as well as expense in profit and loss account. So the relevant percentage for our question is effective interest of 10.84. Now I'm going to use a scratch pad to show this question. So on 1st October X4, they have issued a loan note. Issuing a loan note as an initial is a liability, and this liability will be initially recorded at cash received minus issue cost. This is as per IFRS 9. So how much is the cash received? The cash received is 2.5 million. They're asking in dollars. So I'm just going to show this 2.5 million incomplete. 2.5 million minus issue cost. Issue cost is 3%. So 2.5 million into 3%. You can also directly multiply with 97%. So that is, I'm using the calculator to show the calculation here, and I'm changing from scientific to standard, which I really love. So 2.5 million multiplied by 97%. That is, this will be initially recorded at 2,425,000 after deducting the 3% issue cost. Now, at the year end, 30th September X5, the finance cost that have to be shown in profit and loss account will be the effective interest applied on initial liability cash received minus issue cost. So 2.425 million multiplied by effective interest rate is 10.84%. Answer is 262,870. So 262,870. We have got the answer. Moving forward, which of the following statement is correct in accordance with IAS 40 investment property? So they're asking question about investment property. It's a narrative question. The investment property may be held as owner-occupied property or property held for sale in future. Second, an owned investment property shall be measured initially at its fair value. An investment property may be subsequently measured using cost model or fair value model. An investment property must be depreciated regardless of whether an entity chooses cost model or fair value model. It's pretty much simple. If you have learned IAS 40 investment property, you might have learned that investment property will be subsequently recognized or measured in SOFP at cost model or fair value model. So option C is the answer. Moving to the next question. This is a numerical question. Please read the requirement first. Which of the following is correct? Accounting treatment for Alpha Company according to IAS 21, effect of changes in foreign exchange rate for the year ended 30th September 20x4. Always be very careful about the year end. They're asking the year end as 30th September 20x4. So they have given net exchange loss, exchange gain, and foreign trade payable as the requirement. And it's a trade payable. If you remember IAS 21, trade payable is a monetary item, amount payable in foreign currency. A monetary item should be recognized at closing rate. Now read the question. Alpha Company uses dollar as its functional currency. On 20th October X4, it purchased goods worth Swiss franc 1.2 million when the exchange rate is 1 Swiss franc equal to $1.16. So we have learned that at 20th August X4, a foreign currency transaction will be initially recognized at rate on date of transaction. So we'll be recording purchases as well as trade payable on this date at the rate on date of transaction. The question has given 1.2 million Swiss franc is the foreign currency. So we'll have to convert this into dollar. 1 Swiss franc is equal to $1.16. So divided by 1 Swiss franc multiplied by $1.16. So the amount of purchase and trade payable will be, let me use the calculator once again. I prefer standard calculator. So that is 1.2 million multiplied by 1.16 equal to some issue. Let me try once more. 1.1 million, 1.2 million, sorry, 1.2 million into 1.16 equal to 1,392,000. So the purchase will be 1,392,000 as well as the trade payable will be 1,392,000. Now, moving on, the question says that on 20th September X4, Alpha Company paid 50% of invoice amount according to the term of contract. So they have paid 50% of the invoice amount on 20th September 20X4. That is in our financial year. So since they have paid 50%, the trade payable we have already recorded a trade payable at 1,392,000. So 50% of it is being paid. So that will be multiplied by 50%. So $696,000 is being settled. But when it is settled, how much is the amount that will be paid on 20th September X4? So we are basically settling Swiss franc 1.2 million, 50% of Swiss franc. That is 600,000 Swiss franc, 50% of 1.2 million is settling. At that time, what is the rate on 20 September X4? 1 Swiss franc is equal to $1.14. So multiplied by 1.14. So that will be 600,000 multiplied by 1.14. That is equal to 684,000. So your trade payable was 696,000. But when you paid on 20 September, you paid an equivalent amount of 684,000. You paid less. That means there is a foreign currency gain, forex gain, which we will show in profit and loss account. And how much is the gain? the difference between 694,000 and 684,000, the gain is 12,000. But that is not our answer. At the year end, this particular payable has not been settled. So it's a monetary item. At 30 September 20x4, still trade payable, 50% is pending. 696,000, we have recognized 1,392,000. Out of that, 696,000 has been paid. There is still 696,000 to be paid as our initial recognition rate. Now, as per the Swiss franc, they have paid out of 1.2 million, they have paid 600,000, 50% settled. So right now at year end, 600,000 Swiss franc are yet to be paid. Now, trade payable is a monetary item, amount payable in foreign currency. IAS 21 says that monetary item have to be retranslated at year end. We have already translated at the date on transaction. We are again retranslating at the year end. So 600,000 Swiss franc will be retranslated to at the closing rate on 30 September 2024. That is 1 Swiss franc is equal to $1.17. So trade payable amount will be 600,000 multiplied by 1.17. That is 702,000. So now trade payable actually increases when it is retranslated. From 696,000, it is increasing to 702,000. Since trade payable is increasing, there's a forex loss of difference 6,000. So if you see that there was a forex gain of 12,000, there's a forex gain of 12,000, and there's a forex loss of 6,000. So there's a net gain of 6,000, and the foreign trade payable will be shown at year end at its closing rate of 702,000. So option B is the answer. Actually, you could have directly got the answer if you know that the foreign trade payable will be shown in SOFP at its closing rate. So you could have directly found out what is the closing trade payable amount out of 1.2 million. 600,000 has been paid, 50% has been paid. So the balance 600,000 is payable, which is a monetary item. And it should be retranslated at closing rate. So 600,000 into 1.17. You could have directly got the answer, and within less time, you could have sold this. But I wanted to show you how to calculate the foreign currency gain and loss. Now, remember, we have learned in our IAS 21 class that in profit and loss account, in IAS 21, profit and loss account gain or loss will occur in two situations. When the amount is settled, and second one at the year end on retranslation. Here at 20 September export, there's a settlement of 50%. So there was a foreign currency gain. Then at the year end, when it is retranslated, again, there is a foreign currency loss. This is an excellent question to learn IAS 21. So if you have done any mistakes in this particular question, I would suggest you do the questions that we have done in our class regarding IAS 21 one more time. I would also recommend you to do study hub questions as well as OT revision cases and OT practice question related to IAS 21 in the study hub. So moving on to the next question. Please read this question. Herald, read the requirement first. What will be the diluted earnings per share of Herald Company for the year ended 30 June X4? And be very careful. The question is very clearly asking you to round off up to 2 decimal. So it's a diluted EPS. It could be share option or convertible loan note. Now read the question. Herald Company had 11 million shares in issue on July X3. No shares were issued during the year ended 30 June X4. So there is no need to calculate weighted average number of shares. There were outstanding 250,000 share option to be bought at 2.75 per share on that date. And remember, the year end is 30 June X4, and they have given the number of share option on July X3. So beginning, so there is no need to time proportion. You should be always careful with respect to time proportionment. The nominal value per share is $1, whereas fair value per share today is 3.1 at 30 June X4. The profit after tax for the year was 5.2 million. They're asking you to calculate diluted EPS. Now, how will you calculate diluted EPS? We have learned that diluted EPS is basically profit available to shareholders, that is profit after conversion divided by number of shares after conversion. Now always remember, number of shares after conversion should be more than this 11 million shares. So the profit is directly given there, 5.2 million divided by number of shares after conversion. So number of shares after conversion, we have learned how to find this out. Opening shares, since there is no share issue, that is basically 11 million shares. So that is 11 million shares. These figures are given in million shares. Next one, we have to know how much is the number of shares issued on conversion. That is basically, we have learned that option given 250,000 option multiplied by the option price, that is $2.75, divided by how many number of shares will be issued if it is at fair value, divided by fair value 3.1. So use your calculators to find this out. So I'm using standard calculator. So that is 250,000. The price is 2.75. How much will be if it is issued at fair value? This divided by 3.1 equal to 22,1174. I took it completely in millions, so that is why we got it. So we can say 0.221774 million. So when you total this, you get 11.22 million, 11.221774 million. So now 5.2 million divided by 11.22177.4 million. So that is equal to 5.2 million divided by 11.2217745 million equal to 0.46. You can simply type 11.22. It's 0.4633. They're asking us to round off to 2 digits. So $0.46, that is 46 cents. So moving on to the next question. Which of the following are adjusting events occurring after the end of reporting period, but before financial statement are authorized for issue according to IAS 10? It's adjusting event. The announcement by government about the revision in tax rate that will affect current tax liability, that is basically a non-adjusting event. A fraud discovered in the procurement department which happened before the reporting date. So there is a fraud which has occurred before the reporting date. So at the year end, there is a fraud. So it's an adjusting event. destruction of a machine in a fire that may seriously affect protection. And the next one, loss of inventory caused by flood. That is a non-adjusting event. So in this case, the second one only is the adjusting event. So two only. Moving to the next one. Now read the next question. What would be the amount of borrowing cost to be capitalized in respect of factory building according to IAS 23? So the question is about IAS 23. What is the amount of borrowing cost to be capitalized? We have learned in IAS 23 the borrowing cost related to a qualifying asset should be capitalized with respect to the interest paid during the construction period. And from that, if there is any temporary income, we have to reduce that. Now, please read the question. Beta began construction of its new factory building on 1st March X3. The cost of construction was estimated at 1.5 million. So they started construction of factory on 1st March X3. The company borrowed 800 from a local bank on 1st July X3. Even though they started the construction on March, the borrowing of loan was on July X3. The construction was completed on 30th November X4. Beta had temporarily invested 350,000 of the borrowed amount from July to 31st December X3 at 4.5% per annum. Now remember, we have learned that to start capitalization of borrowing cost, three criteria have to be met. Criteria number one, borrowing cost is being incurred. Criteria number two, construction activities to get the asset is being occurring. And criteria number three, the cost on that particular qualifying asset being incurred. Now, the cost on the asset is being incurred from 1st March X3. The construction has started from 1st March X3, but there's a small problem. The borrowing cost is being incurred only from July X3. So the capitalization period is from 1st July X3, 1st July X3 till the construction completion period, which is on 30th November 20x4. So July X3, August X3, September X3, October X3, November X3, 5 months till 30th November X3. Then it is till 30th November X4. That is another 1 year. So basically there are 17 months during the construction period, during the capitalization period. So the borrowing costs that have to be capitalized as 800,000 is the loan amount multiplied by interest rate as 6% per annum. 17 months, so I'm multiplying by 1 by 12 so that you get 1 month interest to be capitalized into 17 months. So that is equal to, using the calculator to calculate this. So 800,000 multiplied by 6% is per annum. So 1 month divided by 12, that is 4,000 per month, into we have 17 months from 1st July X3 to 30th November X4 during the construction period. That is 68,000. Less temporary income from the investment. So the temporary income is 350,000 has been invested at 4.5% per annum for how many months? From July X3 till 31st December X3. So July, August, September, October, November, December, 6 months into 6 by 12. So that is equal to 350,000 multiplied by 4.5 percentage multiplied by 6 by 12. That is equal to 7,875 is a temporary income. So that have to be deducted. So 68,000 minus 68,000 minus 7,875, we get 60,125, which is option C. Now, always remember, borrowing cost should be capitalized during the construction period, and the expenses have to be incurred during the period. The borrowing costs also have to be incurred during the period. So borrowing costs incurred from 1st July X3 till 30th November X4. If you have committed a mistake in this topic, I would suggest you practice the 3 questions that we have done in our class on IAS 23 borrowing cost. Also, please do certain quizzes and OT revision cases and OT practice questions from Study Hub related to IAS 23 borrowing cost. Now, moving on to the next question. Read the requirement first. What will be the finance cost for the year ended 31st December X4 reflected in statement of P&L regarding power plant? So they're asking finance cost in 31st December X4 profit and loss account. Always be very careful with the dates given in the question. It might require you to time proportion or might require you to calculate the second year calculations. So on January X3, KHS completed construction and started using a power plant that has an estimated useful life of 25 years. According to the law of country where KHS operate, it will be required to restore the plant at site at the end of its useful life. The estimated cost of dismantling and restoring after 25 years would be 4 million. The cost of capital of KHS is estimated at 7%. The present value of $1 after 25 years is 0.184. Now, you have to remember, we have learned that whenever there is present value calculation, that too with respect to a liability or a provision, there will be something known as unwinding of discount. And unwinding of discount will be recognized as finance cost in SOPL if it is related to a provision or a liability. So here they're asking what is the unwinding of discount with respect to the present value on 31st December X4. So let's start on 1st January X3. A provision should be recognized for the site restoration and dismantling. It will be based on present value on January X3. How to calculate present value? Future cash flow, that is $4 million multiplied by discount factor 0.184, you will get the present value as on 1st January X3. So 4 million multiplied by 0.184, the discount factor. Sorry, 4 million multiplied by 0.184, that is 736,000. So this is the present value that we have to recognize at January X3. Now remember, at the year end, there will be unwinding of discount, which will be shown as finance cost. Unwinding of discount, this is the finance cost in SOPL. So how will you calculate unwinding of discount? We have learned this in our classes. That is, it is present value multiplied by discount factor rate into time proportionment. The present value is 736,000 multiplied by discount factor rate. Discount factor rate is the cost of capital given in the question 7% multiplied by time proportionment 12 by 12. From January X3 to 31st December X3, we have a full year. So 736,000 multiplied by 7%, it is 51,520. But be very careful, you have that answer in your option, that is option C. But be very careful, that is unwinding of discount finance cost as on 31st December X3. Our question is, what is the finance cost on 31st December X4? So we have to move forward one more year. So you have learned that on 31st December X3, this provision will be recognized in SOFP at its present value on 31st December X3. And the present value that you show in SOFP is basically the present value plus unwinding of discount. So that is basically 736,000 plus the unwinding of discount finance cost 51,520. So plus 736,000. That is equal to 787,520. $787,520. Now on 31st December X4, that is our requirement. The unwinding of discount, which will be shown as finance cost in SOPL, will be the 787,520 multiplied by discount factor rate 7% into full year 12 by 12, 55,126.4. We have that in option B, 55,126. So moving forward to the next question. Please read this. On 1st July X4, P Limited acquired 30% shares in A company. The acquisition agreement was such that it gave P a significant influence but no control. So significant influence means associate company, and it should be accounted under equity method. Which of the following is correct regarding initial recognition of investment in A Limited according to IAS 28, investment in associate? Cost of acquisition of shares in A company, cost of acquisition plus profit of associate, 30% of fair value of net asset of A company, and cost of shares acquired minus 30%. They're asking about initial recognition. Be very careful about that. They're asking initial recognition. So initially that will be recognized at cost of investment, that is purchase consideration. So option A, cost of acquisition of shares in A company. Now I'm just using my scratch pad to show you the equity method in case of investment in associate. We start with cost of investment, that is purchase consideration paid to acquire the shares in associate company plus the parent company percentage of post-acquisition profit of associate company minus any dividend received from associate company minus any amount written off or impairment regarding impairment of associate. But that is equity method. They're not asking any of those things. They're very clearly asking you about the initial recognition. So it will be initially recognized at cost of investment, that is purchase consideration, cost of acquisition of shares in associate company. Option A is the answer. Now, the next question. Current ratio of Trivi company is 0.9:1 as at 31st March 20 X4. Which of the following statement is true for Trevi Company. 1. Current assets are greater than current liability. The company's liquidity position is in jeopardy. We have learned that current assets are greater than current liability. In that case, numerator is greater than denominator. Current assets are shown in numerator. Current liability is in denominator. If numerator is more, then the ratio will be better. 0.9:1 denotes current assets are lesser. So 1 is not the answer. And we have learned that the ideal ratio is 1:1 or 2:1. So that means if it is below that, its liquidity has been affected. And it's 0.9, that means current assets are lower than compared to current liability. So its liquidity position has been affected. Option 2 is the answer. Moving forward. Classify each of the following items into appropriate category according to IAS 41 agriculture and IAS 16 non-current asset by clicking on the relevant box in the table. Now, before you do this question, you have to understand this. You have to get all the 3 correct to get the 2 marks. If you commit a mistake in any one, you will lose the entire marks and you will get 0 mark. There is no proportionate mark. So biological asset, IAS 41. Plant-based bearer asset, we have learned it is IAS 16. Examples are rubber tree, oil palm, etc. are plant-based bearer asset, and we have learned that it should be treated as accounting standard 16. Harvested cotton is inventory, IAS 2. Next, the profit before tax of Rocky was 750,000 for the year ended 31st March X3 after charging depreciation on building 120,000. The tax allowance for the building for the year ended amounted to 150,000. The tax rate is 30% on taxable profit. Without considering any adjustment other than the above, select which amounts will be reflected in financial statement for Roxy for the reporting date of 31st March X3. Income tax expense, deferred tax liability, and current tax liability. So let me use the scratch pad to show this calculation. Now, income tax expense, it will be shown in profit and loss account. So they have given few options, SOPL 9,000 and SOPL 216,000, SOFP 9,000 and 216,000. Anyway, this last 2 will not be the answer because income tax expense will be shown in profit and loss account. The question is it 9,000 or is it 216,000? So income tax expense 750,000 is the profit after charging depreciation as per the books. But tax allowance for depreciation is 150,000. So 750,000 plus 120,000, adding it back, then reducing this depreciation or allowance, tax allowance 150,000. So using the calculator for that purpose, 750,000. So 750,000 plus adding back depreciation as per books minus tax allowance 150,000 equal to 720,000. So 720,000 is a taxable profit and tax rate is 30%. So multiplied by 30% is basically 216,000. This amount will be shown as income tax expense in profit and loss account. So second option, SOPL 216,000. Deferred tax liability. Deferred tax is the taxable difference multiplied by tax rate. So taxable difference depreciation as per the book is 120,000 and tax allowance is 150,000. So there's a difference of 30,000 multiplied by tax rate 30 percentage, that is equal to 9,000 is the deferred tax liability. It will be shown in SOFP. Then current tax liability, that will be the amount of provision. Current tax liability will be 216,000 and that will be shown in SOFP since it is a liability. So next, in accordance with IAS 38 intangible asset, which of the following cost would be capitalized in financial statement of a company? They're asking IAS 38, what would be capitalized? We have learned that development expenditure after the criteria has been met will be capitalized. And we also have learned any purchased intangible asset will be capitalized. So option 1, 1.1 million spent on researching a new raw material with the objective of reducing wastage. Research expense we have learned in accounting standard 38, it will be expense off in P&L. So 1 is not the answer. 1 million paid to acquire a patent that will have a useful life of 7 years. Acquired, purchased asset have to be capitalized. So second will be capitalized as an intangible asset. So second statement will be there in your answer. 850,000 spent on modifying a software that was internally developed 2 years ago. That is internally developed software, internally developed asset cannot be capitalized. So 3 will not be correct. So only 2 will be capitalized as an intangible asset. Moving on to the 15th last question in section A. P company acquired 80% of S on 1st October X3. Identify whether each of the following statement are true or false in relation to the acquisition. P paid an initial cash amount of 62 million and agreed to pay owners of S a further 26 million on 1st October X5. So they agreed to pay 2 years later, that is deferred consideration. And 26 million deferred consideration should be considered while calculating goodwill on acquisition. That is true. Click on there, you can see the color change. Now, the amount that will you show in goodwill calculation is not 26 million. That will be the present value of this 26 million. But definitely this deferred consideration will be considered. Next one, when preparing consolidated financial statement on 31st March X4, 20% of profit or loss for the year should be attributable to NCI. Parent company owns 80%, so NCI is 20%. So profit attributable to NCI will be 20%, but post acquisition. Always be very careful with the year end. The subsidiary company was acquired on October X3 and year ending is on 31st March X4. So October, November, December, January, February, March, only 6 months can be considered. The end date 20% cannot be considered. 20% into 6 by 12 post acquisition have to be considered. So they say 20% will be considered. That is wrong. 20% into 6 by 12 will be considered. So that's it. This is over. So I hope you have understood this discussion on section A. If there is any doubt, you could contact me in the WhatsApp group. I'll be happy to help you and clarify your doubt. So thank you. All the best for your examination.